Hello and welcome back. This is Christopher Aaron. It is May 1st, 2020. This is going to be a special video. This is a market warning for everyone, including stock market investors, precious metals investors, bond investors, commodities investors. Now, the sentiment that I see in the market today is such that the Federal Reserve and the world central banks have saved the day. They've printed enough money to cause everything to settle down, and we are past the worst of the market dislocation that was triggered by the coronavirus. And I do not believe that this is true. When we go back and we look at what happened with the Spanish flu in the United Kingdom, the first wave in 1918 was right here, as measured in deaths per 1,000 people. The second wave that came later that fall and into the winter, 1918 into 1919, was 5 times worse than the initial wave. And a thinking individual has to ask themselves at this exact point, might we only be here, relatively speaking, as far as the coronavirus goes? And we saw what the impact on the stock market was. We saw what the impact was on precious metals, gold and silver, and the mining companies. We saw the impact on commodity prices, including oil, in just that first round. And so, what I want to do is rewind and look at other periods in history where we have seen significant deflationary events occur over a multi-year period. Now, the crash of 1929, we're going to look at that in one moment, was, of course, triggered by a very different set of circumstances. We were talking money printing by the Federal Reserve, unsustainable stock market bubble, basically feeding on itself, and then a relative tightening by the Federal Reserve, causing some of that easy money to leave the stock market, which precipitated a major decline. Clearly, that is different from the set of circumstances that we have seen with the coronavirus, but the similarity was the unsustainable nature of the stock market itself. And so when I look and go back, and a lot of people do not study this period in much history, so let's look at it. This is the Dow Jones Industrial Average from 1929 to 1932 in crystal clear detail. Let's look at some of the technical signatures that's set up in the market. We're talking from the peak in 1929 to the initial bottom, a 48% decline in stocks in percentage terms in just 2 months, followed by an initial V bottom, and then what? A 50% Fibonacci retracement in here green. Notice these little silver lines right here, a 50% retracement of the entire initial crash happening before giving way several months later and leading to a 90% total decline in the stock market in a little under 3 years. So the most severe stock market decline that has ever been witnessed. But when you look at the fundamental metrics for valuation, which we will look at in a moment, you will see that the stock market presently is actually more overvalued than it was in 1929. And so let us zoom in on the period here of this initial crash from 1929 and just look at some of these signatures. Now, I'll pause here for a moment and just tell you the nature, the basis of the work that you are now looking at. It is technical in nature. We are talking about what is the market actually doing. And I mentioned some of the fundamentals that led to what the market was actually doing. Printing of money by the Federal Reserve in the mid-1920s, over speculation, et cetera, a tightening coming in here into the final part of the blow-off move in 1929, leading to the initial crash. So we can understand the fundamentals, but the focus of this channel and this service is to study the actual market signatures, which I argue with you is the only thing that really matters. What is the market actually doing? We could read books about what caused the market to do what it did, but what is the market actually doing is the focus of this channel. 48% initial decline in 2 months. Notice this V bottom, this shape right here. This is a very important technical signature for an unsustainable bottom. A bottom that is not healthy in nature. It did not feature enough consolidation, enough buying and selling all happening throughout the lows for this to be very sustainable. Notice this wedge pattern here. A wedge pattern is often a topping pattern coming into a 50% Fibonacci retracement of the entire decline. This was the initial part of that 90% crash in 1929. Let's compare this, and that happened over 5 months. So keep that in mind. What were people thinking into month 3, 4, and 5? They were probably thinking, wow, that was one heck of a scare, but we're past that. We're back into the next phase of the bull market. Just give it a few more months, we'll be back to new highs, right? Of course, what happened? 90% decline from the peak to the bottom 3 years later. Let us compare this period to the present. The same Dow Jones Industrial Average 90 years or 3 generations later. How we try to act smart as a society, as a civilization, and in some ways we are. You know, we've advanced, we've sent rovers to Mars, we have put people on the moon. We have become energy independent here in the United States. A lot of amazing things have happened, yet human nature and human psychology do repeat throughout time. As far as the boom and bust cycles of the 2 leading emotions that go into these overexpansion followed by contraction periods, and of course we're talking about greed and fear, as they play out over and over again in human psychology. So looking at the similarities, a 39%, remember it was a 48% decline back in 1929. Here we have a 39% decline, pretty close in percentage terms in the grand scheme of things. This one happening not in 2 months, but in 1.5 months. That same V bottom, the same wedge shape, bringing us to the same 50% Fibonacci retracement of the entire decline. And look at this. The wedge has already broken, and now we're retesting that from the upper side, and it looks like this market wants to continue suckering people into it and getting everyone to believe this was just a fluke, this was just a one-time thing, nothing to worry about here, we're off to new highs within the next couple of months, right? If you stop and look at the mainstream opinion right now, I would go so far as to say not even mainstream, but even contrarian investors. Seems to me everyone is thinking that we are past this and that was a one-off fluke event and there's nothing more to look at here. Everyone get back to doing what they were doing before. Remember that example from the Spanish flu. The second wave was worse than the first. And it's not so much just about the flu. I am one person who happens to think that the flu itself would be fairly bad. A greater than normal percentage of people would die around the world. That would be a significant loss for humanity, of course. But I believe this thing would peter out within 6 to 12 to 18 months, and probably the world would be okay. So the comparison between the crash of 1929 and today, as we can see this side by side now, the similarities in the technical signatures, if you ask me what has the potential to bring the current time period to mirror a 90% crash or something approaching that magnitude, it's not the virus itself. It's actually going to be the government response to the virus. Because back in the Spanish flu at that time, yes, we had a greater number of people die on a greater percentage basis thus far than the coronavirus. However, we did not have this massive government interference. governments around the world forcing lockdowns, at least in the largest developed nations around the world, curtailing businesses, infringing on civil liberties, everything that you can imagine, right? We did not have that. By far, the most significant response was back in the Spanish flu was a humanitarian and a medical response. But we did not have the massive economic catastrophe that is now underway for so many millions and hundreds of millions of people around the world. So this is why I feel like the technical signatures here are matching up relatively well. And if we zoom this all the way out, you ask, okay, so you want to see the big picture now, Dow Jones Industrial Average. There was that crash of 1929. Here's the setup today. Notice the pattern leading into it, this expanding megaphone pattern where the highs were coming up, right? Notice, so a high, a higher high, several higher highs here, but notice the lows, lower lows at the same time. This is a pattern of instability. And then we had the blow off here, followed by the 90% crash, which wiped out 3 decades of gains in just 2.5 years, right? The entire first couple of decades here, several decades, and in fact, if we were to extend this back into the late 1800s, you see we wiped out almost 4 decades of gains in about 2.5 years here in the largest industrialized economy in the world. Look at the pattern that is set up over the last couple of decades here with higher highs and lower lows and the blow-off period right here. So if you ask me, where are we right now? It's somewhere like here, very early 1930, using the crash of 29 comparison. There are so many startling similarities as far as the technical signature go. And so then we have those people that wonder, well, what about the fundamentals? Well, what about them? Right now, the stock market, when we look at dividend yields, which is dividend yields, of course, the amount that you are paid as a percentage to be an owner of stocks. Let's say you want to own stocks for the long run and you want to say, well, what's the point of owning stocks? The point really is to get paid. It's to get paid a percentage of the profit of the businesses, i.e. the stocks that you're owning. And so if we look at levels here that previously represented bubbles, such as the crash of 1929 and the 90% drop, notice that we are above those valuations here. This is a great chart, by the way, available in the public domain from longtermtrends.com. And we have the crash here that we can see. So stocks more overvalued than they were in 1929 from a fundamental basis. Aha, but you know what else? They have been more overvalued for the last 30 years, right? So this is the point of studying technical analysis, because if you were going back here, look, at the time when stocks first became overvalued or in bubble territory right here in the late 1980s, or let's say in the mid 1990s, and you said, well, I'm going to wait until stocks are properly valued. Guess what? You've been waiting for 30 years. And so the point of technical analysis is to acknowledge the fact that fundamentals do not matter except over the very long run. But in the long run, we are all dead anyway. And so, truly, the fundamentals matter very, very little over any meaningful real-world time frame. What matters is what is the market actually doing. This is largely a function of psychology and human nature, as we talked about before. And so if there is another round of deflation ahead, maybe not today, maybe not tomorrow, but maybe within the next couple of months, as we saw in that example from the Spanish flu, having a second round that was 5 times worse than the first round, and we say that this was the market reaction to the first round of deflation, and we notice stocks dragging silver, commodities, and gold miners down all with it, basically all acting as one market during the deflation. And what held up relatively better? Gold, the US dollar, and US bonds. Then we have to seriously ask ourselves this question and make sure we're clear on the answer. that if there is another round of deflation coming, the things that perform best are money. This is the definition of deflation. Deflation of what? Deflation of things. And we just saw in that previous slide that all those things, whether we're talking stocks or commodities or silver or gold miners, all the things that are traded on exchanges to one extent or another tend to lose value relative to money. Now, in previous deflationary periods, this was an easier equation to answer. So the answer was you hold money, which back in the 1920s, money was equivalent to gold because the US dollar was backed by gold. This is no longer the case. And so we saw in the last chart that gold and US dollars held up relatively well. The market is basically doing the same things it did in the 1920s. It's just doing so independently now of that official government link between gold and the dollar. So, to reiterate, what does the best during deflation if one is concerned that perhaps there is another round of this coming up, which I think you should be concerned about? The answer's US dollars/bonds hold up very well throughout history. Gold, get your hands on it while you can. And we have one more final candidate, the new kids on the block. Are there any new forms of money that we could consider for these new kids? And no, I'm not talking about the new kids back from the 1980s and early 90s, but they're fun to look at sometimes. I am talking about the potential for a new form of money to be appearing on the stage. And this is put here as a question mark because we don't know. We do not have the answer to whether or not these cryptocurrencies are going to serve as forms of money along with US dollars and gold. But this will be very interesting. And if one is a speculator and wants to bet on this thesis, then that is something that you may want to consider. So we are in a period where, if you ask me, all of the candidates, all of the investors at this time are convinced that the deflation is over. The prevailing sentiment in the market, and it doesn't matter which asset class you're looking at, whether you are a silver investor, whether you are a stock market investor, whether you are an oil and commodities investor, I see the same sentiment across the globe, which is that, phew, that's over. And I think that's too easy. I think when everyone believes pretty much the same thing, that is a warning sign. We looked at the examples from 1929. The technical signature between now and 1929 is eerily similar. And markets do not repeat exactly the same, but they often rhyme. And if you would like to go further into this type of research, please know that we offer a premium research service, which is called Precious Metals Intelligence. It is called Precious Metals Intelligence, but we also cover the US dollar, the stock market, and other commodities such as oil. We do premium videos like this. The one that went out just 4 days ago included even more in-depth analysis. There is a major signal that is setting up in the markets. When we look at the ratios of certain of these components in here, we are seeing ratio analysis that is strongly confirming the thesis that there is another massive round of deflation coming up. I'm not going to reveal what that is here, but it is a ratio analysis. You can find out more about that on the homepage if you would like to subscribe. We also include the exact buy and sell signals that we are using here for any of the trades that we are making. If this resonates with you and you're just saying, well, I don't want a service, I want to speak to you, Christopher, I understand that. That is why I do offer consultations. I take no fees, no funds from any of the investments that we profile in the service here. I work strictly with individuals on a one-on-one basis. I give you a what would I do in your scenario type of outlook, and it comes from a researched, independent perspective. So know that you can reach me on the Consultations tab if you would like to do so. one way or another, make sure to hit that big red subscribe button because you do not want to miss these videos. I publish these free videos a couple times a month, and we try to look at some of the most important things that are happening here. And this is a very exciting time to live with. We are seeing signals that have not appeared since 1929. I could not ask for a better time to be a student and a participant in these markets. So if that interests you, make sure you subscribe to these free videos. And I do want to say thank you very much to those people who are supporting these free videos on Patreon. It means a lot to me. And know that you can send requests if you support this channel on Patreon for future videos. And I try to incorporate that in. So keep an eye on that 50% Fibonacci retracement level in the Dow Jones Industrial Average. We are at that point right now. Everyone is convinced that the worst is over. Is the majority right, or should we be contrarians at this point?